If you would like to turn on your camera, we would enjoy for you to turn your camera so we can see your faces. If you're able to do that, that would be fantastic.
Seeing just mine is traumatic. So
Yeah, exactly. We don't want this just to be a conversation between Jordan and I. So please turn your cameras on so we can have you be part of this conversation. Thank you for joining us in today's Power Hour. Welcome. I see some names here that are very familiar. Please turn your cameras on if you're able. So, oh, hello. Thank you, Sarah. Sarah wins the first prize. Woohoo! $1,000 off her MLS. I'm just kidding. Oh, Heidi turned hers on. She gets $1,000 off her MLS. If I keep saying this, everybody will turn their camera on. It's a joke. You're not going to get $1,000 off your MLS, but I'm just trying to get you to turn your cameras on. All right. We'll give you a Starbucks card. How about that? We'll do that. Since Sarah turned hers on first and Heidi second, Emily, make a note of it. We'll send them a Starbucks card. Let's see if other people turn their cameras on. There we go. We're sending love. We're sending love. Betsy turned her camera on. There we go. John turns his camera on. I'm going to run out of Starbucks cards if we get everybody to turn their cameras on. Thank you, everybody, for being here for our July Power Hour. We have Jordan Levine here with us, a great speaker. Elizabeth's turning her camera on. Now I'm just going to run out of Starbucks cards. Okay. Rinchin, thank you for turning your camera on. This is fantastic. I'm just going to keep saying Starbucks cards, and everybody's going to get Starbucks cards. Maybe we give out tea cards or something. Maybe there's tea at Starbucks. Thank you, everybody, for being here. It's 12:01. We're going to give it just a couple more, just maybe 1 or 2 more minutes because Jordan has so much to share. So again, if you want to turn your cameras on, I'd really appreciate it. Jordan, now you're not just going to look at my face. You've got some beautiful faces to some key members here. So
I appreciate it.
Before we get started, just a couple reminders. Thank you to my bridge members for being here and affiliates. Upcoming events, don't forget, we brought back our in-person marketing meetings. They're not on Mondays anymore. They're on Thursdays. So now it's Thursday marketing meetings. And they're every Thursday at the Bridge office. You get a chance to spotlight your listings, network, listen to speakers. I heard there's some raffles. We had somebody who won some like $200 during that raffle time. So they're giving away money. 8 a.m. breakfast starts, 8:30 the meeting starts, and no registration is required. So please, this is a great opportunity to come back out, start networking in person, and every Thursday. Broker meeting, we are bringing those back. They're going to be every month starting August 5th. It's online and virtual, so you can sit in the comfort of your offices. Really important, especially now with all the changes taking place. This is available to bridge brokers only on the association side, not the MLS. But please join us. There is a link in our events section on Bridge Association. Register and join us for the first meeting August 5th at 10 a.m. We have a in-person candidate happy hour happening on August 7th. Join us in our local government relations committee for a happy hour with candidate conversation with Alameda County District 5 Supervisor candidate John Botters. It's going to be in person at the Bridge Association office on the first floor. Registration is available on the calendar. This is just a few events that we're throwing both in person and virtual. So please check the calendar and website for events. And now we're going to get straight into our speaker. Let me introduce my friend Jordan Levine, the C.A.R. Senior Vice President and Chief Economist. Jordan Levine is the Senior Vice President and Chief Economist for California Association of Realtors, where he is responsible for economic and housing market research, as well as policy analysis for the C.A.R. legislative and advocacy efforts. He has a BA in Business and Economics from UC Santa Barbara and a master's degree with merit in the International Economics from the University of Sussex in England. Jordan is a California native who grew up in San Diego, and has lived all over the state. He currently lives in the Central Coast with his 2 kids, where he enjoys camping, the dog beach, and evangelize. I can't even say it. He loves e-bikes. I love that part.
I'm trying to sell everybody on the e-bikes. So
I love that.
Yeah,
And
takes all the intimidation out of the getting out and about. So if you ever get tired, you got a backup
I,
plan. So.
I like the e-bikes thing. Well, you know what? You got more on this file, but I'm going to let you take over from this point. I'm talking too much. Jordan, Levine, take
Thank
over.
you.
Thank you so
Thank you
much.
so much for having me back. And I'll just say you guys are very lucky to have such a on point AE and CEO because things are changing so much. And I love hearing the broker stuff is back. One of the things I've seen just anecdotally out in the field is like agents are now, and I think even the experience, and maybe more so even the experienced agents are like looking to their brokers now to help navigate all this stuff. I think there used to be a kind of stay out of my way and let me get on with life kind of an approach to your broker. Right now it's like, whoa, what do I do, kind of. And so I just think, having these conversations and staying on point, and actually that's a perfect segue really into my slide, so I don't have to punish you with looking at my face the whole time, is just that, that is kind of the recipe for success as far as I see it. I put on my first slide that we're in the economic twilight zone, and I should mention too that I'll try and keep an eye on the chat as we go through here. So if you have questions or want me to stop on something or whatever, just let me know, and we can dig in more on any specific topic. I also made sure that Divina and everybody has these slides, so if you need these afterwards, and actually I think the slides, selfishly, I think they're going to really help you in your business, because the data ultimately is the thing that's telling the story we want to tell. Newspaper headlines are pretty scary out there. You've got people trying to time the market and all that stuff. But the data is really your friend. But yeah, we're in this kind of like economic twilight zone, and there's just so much stuff happening. And I call it the twilight zone because from an economic standpoint, I think we're kind of waiting for bad news, because bad economic news is going to give us those Fed rate cuts that everybody is kind of, desperately waiting for. And I think that kind of misses the point, right? Where normally in economics, you root for more people to have jobs, right? For incomes to go up, for unemployment to be low. These are like typically things that are objectively good that we can all agree on. But because everybody's so hyper focused on what the Fed's going to do every time we get a good jobs report or strong spending numbers, right? Or unemployment that goes down. Everybody freaks out that maybe those rate cuts aren't right around the corner. And you see the bond market freak out, and we get a lot of interest rate volatility on the mortgage side. And that's where the rubber meets the road for us. On top of that, we've got all these practice changes happening, right? And for better or worse, I'm not in the legal department at C.A.R. So I'm looking at this stuff from like a 30,000 foot level. But I think regardless of all of these kind of myriad challenges, and I should mention too that, I'm going through a transaction right now. I'm putting my money where my mouth is when I say don't wait for rates. I close on Monday the 5th. And if rates end up dropping in the future more quickly than what I'm currently forecasting, guess what? I'm going to go out and refi, but I'm not going to wait for prices to go up another 10%. But I've realized through this transaction just how much consumers still need a really good agent, right? Like, I don't think you're going to find a consumer, a buyer, a seller out there that's, more in the weeds of the real estate industry than me. I look at this stuff every day for a job, and just going through both sides of this transaction, I realized that, we need realtors and a good agent now more than ever. So all of this stuff's going on out there. It's going on for us too, right? And we're navigating all these crazy life changes as well. And the transaction is tough. There's no inventory. So you need somebody that's going to help you structure your offer. You're going to need somebody that's plugged into the best lenders that can get the deal done and help you make your, offer the most attractive and get accepted. And then you've got to navigate all of the inspections and what happens when the roof turns up terrible, and like, yet there was a bunch of backup offers, and how do we stay competitive and help me not make a huge mistake, and all of these things. And on the sell side too, it's not a 2-page RPA anymore. There's a lot going on. Consumers' expectations have changed. Their purchasing power has gone down, but their tastes haven't, right? So they expect a lot more for less money now. So even on the sell side, there's a lot of challenges. bottom line to all this rambling is just that, I'm still optimistic about the profession of being a realtor, but the kind of recipe for success, whether we're talking about the macro environment, practice changes, just how difficult the market environment is to, really step up our A game. I think consumers are going to still want to work with agents. They just want an agent that really can actually help them, right? And knows their stuff and can help navigate all these crazy ups and downs, because they're not in the weeds as much as me. And even my head was spinning, right? So that's both the good and the bad news, is that yes, consumers still really need us. But yes, also, right, they need us to bring our A game, and it's going to be a survival of the fittest kind of environment, especially with the practice changes, right? They might be taking a look at more agents instead of going with the one that their brother-in-law told them was the bomb, right? And therefore, you've got to not just be a good agent. I kind of use the sports analogy. I shouldn't even be talking about this practice stuff, honestly. I should leave that to Gov. But I kind of look at it through the lens of sports. Back, I think, before all of these practice changes, it was good enough just to be like a really, really good shortstop, right? You could dive into the gap, you could catch the ball, you had a rocket arm and all of that stuff. Now, it's not enough just to be really good at your game. You've got to be able to communicate why you're such a good shortstop, right? And all of the preparations that you do and your philosophy towards practicing and staying up on your fitness and yada, yada, whatever all goes into that, right? And that's a different skill set, right? So you've got to be really good and be able to tell people what you bring to the table. If you can do that, though, I think sky's the limit. Let's get into the weeds a tiny bit, right? Through this kind of economic twilight zone lens. The kind of bad news when it comes to, predicting what the Fed's going to do is that the economy is still pretty strong, right? We have ongoing job growth, incomes, GDP, you name it. They're all pretty much at all-time high levels. Consumers are still spending a bunch of money. It started to downshift recently, but we're still setting new all-time highs. It's just not going up by 20% the way that it was a few years ago. The other thing is, and this is, really kind of upset, I think, the treasury market and why we've had so much interest rate volatility, is that the Fed's pretty much just doing what they told us they were going to do. And we can argue about whether that's the right thing or not, but they haven't thrown us a bunch of curveballs, right? They said, we're going to raise rates to 5.5% until we get inflation totally stamped out. And lo and behold, they're sticking to their guns on that front. Meanwhile, the bond market has continued to, I think, be over optimistic that those rate cuts are just always right around the corner. Then we get a new strong jobs report, strong inflation number, what have you, good economic news, more or less on like things like income and jobs and GDP, sends the bond market kind of into panic mode that maybe those rate cuts aren't right around the corner, and hence all of the volatility that we've had up to this point is just that they're doing what they told us they were going to do. The good news is, and again, through this kind of bizarre good news is bad news, lens, is that I don't think the economy is as strong as these headline numbers would have us believe. I think they're starting to become a kind of tale of two economies starting to emerge, right? Keep in mind, all of this data that we look at is aggregate data. So we take all the spending by rich people, all the spending by poor people, you put it all together, and that's the aggregate consumer spending number. I think people at the top end of the income spectrum are still punching above their weight, right? You own property that's gone up in value, stock market's still really high. Those high income remotable jobs are at very low levels of unemployment, even with recent layoffs and things like that. Meanwhile, people, making 60 grand a year or less are, these kind of inflationary chickens are finally coming home to roost on people, I think, after, the cost of everything has just gone up so dramatically. And when you look at it by sector, right, when you look at spending at places where, the median income of people that, eat there, places like fast food restaurants, they've already been in decline for over a year. Discretionary spending, the thing that's really been driving a lot of the growth, is people hitting the bars, the restaurants, the hotels, going on trips. That's mostly spending by folks at the high end of the income spectrum. even that stuff is starting to fade, and we don't have all these new car sales and stuff backing it up. And you can see that in the credit card data, that people aren't as strong, healthy financially as these kind of big headline numbers would have us believe. It's just being kind of masked by the fact that you've got a lot of people at the very high end with a lot of wealth that's been created over the last handful of years because they owned assets, stocks, houses, what have you. The other thing is, I think the other shoe's still probably going to drop on the office sector, and that could impact the financial markets, right? We saw what happened when only just one or two banks went under. If these kind of mid-sized regional banks, which are mostly the ones that are on the hook for all this office debt, start going under, then the economy is not as strong, stock market's not as strong. I think that will help from the standpoint of whether the Fed will have the cover to lower rates, right? Because when the economy is not as red hot as it was, that's what they're waiting for. But at the same time, it could impact us on the residential side, even though we don't do a lot of office market transactions. If it impacts banks and the stock market goes down, then people in the Bay Area don't feel as rich and they don't buy that new house that they wanted to move into. They tighten belts and all of that kind of stuff. So, what does it mean for all of us? Again, I kind of already alluded to this in my lengthy opening remarks. I think it just means that, the recipe for success for us is nose to the grindstone and really step up your game, because it is going to be a kind of volatile environment. The worst is already behind us. So I think the good news is we can tell all those buyers that are sitting around waiting to perfectly time the market when it hits bottom and get that perfect rate and lowest price. You can tell them start looking in the rearview mirror, right? But also, it's not going to just be a straight line V-shaped bounce back recovery that will kind of facilitate you taking your foot off the gas or throwing it in cruise control or anything like that. The market is very sensitive to these rate changes, and I'll show you that here in a minute on some of these charts. And I think if you're going to have just a lot of volatility still in rates, because you still have folks just waiting for that rate cut, and every piece of strong economic data sends us back up to 7% or higher, right? And people take a big step back and wait, and it kind of validates your brother-in-law's email newsletter telling you just wait, later in the year rates are going to be cheaper and there's going to be a bunch of foreclosures and all of that stuff. We will see listings start to come back, and I think this is the first time since I've been working at C.A.R. when I can say that inventory is like the bright spot. But we are getting more inventory coming online, even though you've got a lot of folks locked in at under 4% mortgages out there. That's starting to thaw a little bit, and I think that will continue to be the case. But again, I just want you to kind of keep your foot on the gas and really embrace the fact that we are the consumer's trusted advisor and market expert, and they still need us more than ever. But that just means it's incumbent on us to really step up our game by virtue of the fact that you're sitting here on this economic speech at noon on a Wednesday. Tells me that I've got absolutely nothing to worry about for you all, and that sky is the limit. But I just think that you're going to have to really lean into being able to bring it from a kind of bottom line standpoint. Sales are going to continue to go up. We were at 225,000 units statewide last winter. It's already rebounded to about 270, 280 pretty consistently. We're going to break through that 300,000 unit mark probably by the end of the year, which will translate to a double-digit increase in the number of transactions. So the bottom already happened, but keep in mind that this is a double-digit increase from a very low number, right? So it's not a throw it in cruise control, kick your feet up on the desk and ride the wave kind of a number. The newspapers love to talk about the double-digit increase that I'm forecasting, right? But if I have $1 and you give me another $1, I just got 100% raise, but I've still only got $2. That's the part they always forget to tell you on that stuff. And so just again, moral of the story, elbow grease, foot on the gas, whatever your favorite metaphor is there. Prices are already going up and they're going to continue to do so. So those buyers that are sitting on the sidelines waiting to perfectly time the market, tell them, again, they already missed the boat. When I went and bought my car a year ago, the guy goes, "Oh my God, you're the chief economist at C.A.R." He goes, "You got to see this email my brother-in-law just sent me." And he like turned his computer monitor around and his brother-in-law was like, "Sell your house. The foreclosure wave is coming." all this like terrible negative stuff. And actually that guy just made 11% by keeping his house for another year, right? So like buyers forget that it's not about time in the market. It's about getting in as soon as you can. And it's a long-term game. This isn't a Bitcoin, right? And I think that if we can actually show them the data, it kind of flies in the face of a lot of these negative headlines and underscores why folks should be getting into the market and not worrying about timing interest rates. If interest rates go down a lot faster than what I'm predicting, my bad forecasts cost you nothing, right? You go out and refi, your mortgage payment gets a lot cheaper. You just got a free Range Rover, on that kind of my bad forecast cost you nothing. If your brother-in-law is wrong and you trust him, right, and rates don't plummet and prices keep going up another 10%, his bad forecast just cost you a lot of money. And so it's like in economics, we call that a type 1 versus a type 2 error. But the bottom line is trust the data. And actually, that's why I sent these slides through, is because the data really kind of tells our story. Drag you through some of this macro data real quick. I got to justify my student loan, but also because everything is rate driven, right? Everything is viewed through the lens of what is the Fed going to do now, right? What does this mean for the Fed now, both in terms of the markets, right, but also consumers who are bought into that brother-in-law effect and are waiting on the sidelines for those rate cuts to happen. If you look, the Fed funds rate is still at 5.5% essentially. We have had some reprieve on the bond market of late, right? But you can see how just kind of wild this treasury market has been, and the 10-year bond is the one that really matters for us because that's the one that influences 30-year fixed rate mortgages, right? Even when the Fed was in the midst of their tightening cycle back in the summer of 2022, telling us, look, we're at 3% Fed funds rate right now. We're going to go up to 5.5%. They've been telling us that for a long time, and they did it. Look what was going on in the treasury market, the blue and the yellow stuff back in mid 2022. It had already plateaued and even started coming down a bit towards the end of 2022 on the assumption that, yeah, they say 5%, but they're never going to take us that high, right? Or even if they take us to 5%, they'll start backing down quick as this kind of breaks the back of the economy. Well, lo and behold, they stuck to their guns. The economy remained strong. We continued to recover from the pandemic and set new all-time highs for jobs, GDP, income, you name it. And every time the next strong economic data point came out, you could see the bond market reverse course. It was going down towards the end of 22, then it jumped back up at the beginning of 23. And then they said, oh, we missed the boat back then, but now for sure the rate cuts are coming, right? And the bond market starts to come down in the first part of 23. 23 was still a strong year economically, and they had to reverse course again. So, right now at about 4.5% on a 10-year, the good news is we're kind of where we should have been all along. The bad news is it's kind of prolonged how soon the recovery could really start to gain momentum because all of this volatility has really influenced home buyers in particular to wait for that lower rate, right? To wait for those rate cuts, which are always just right around the corner, even though the economy is very strong. Right now, rates have come down a bit. Last week, the Freddie Mac number was 6.78%. So we're back below 7%, and what a difference a year makes, right? Back then, 6.75 looked pretty terrible because we were still thinking about 3%. When are we going to get back to 3%, right? Now that rates have gone up to 8, then we're hovering above 7% for a good while there. Now 6.75 seems all right again, and folks kind of remember that actually this is more in line with the historic norm, that 3% was never the normal. I think I told you guys last time, maybe I didn't, but when my dad got his mortgage back in like 1979 or 1980, he went into the savings and loan, got a 12.5% mortgage. And he said he walked out of that thing and was like high-fiving strangers in the parking lot because he was like so pumped. 12.5% was like an unbelievable, phenomenal rate. I think people are starting to get a little bit more perspective now that we realize 3% is like firmly in the rearview mirror. But I still think you have a lot of people out there waiting to time the market for that perfect rate and forgetting that they've already been left in the dust on the price front, right? That we've had multiple years now of consistent growth. I've been telling people even back in 2020, like, jump in. And then when rates went to 3%, I said, now you really want to jump in. My dad would be killing to borrow money right now. I wish my dad was around, right? If they would have listened to me, they would have already made boatloads of money, right? They would have just sent their kids to college for free on the basis of the appreciation we've seen in places like Oakland and Berkeley and just Alameda County overall. People are starting to get really excited because the inflation numbers have gotten a lot better, right? And so they're saying, oh my gosh, look, my brother-in-law knows what he's talking about. These rate cuts are right around the corner, and I should just wait till the end of this year for a better number. And yes, if you look at the inflation numbers, we've improved from about 9% rate back in 22 to, if you kind of drill into the second decimal point, we actually did drop below 3% there for the first time since this stuff started ramping up. But I want to make sure that we are not over celebrating this number, right? You want to keep the corks and the champagne bottles on this stuff, because the last mile on inflation is going to be the hardest to get rid of. It's taken longer to go from 4% to 3% than it took to go from 9% to 4%. And that is because this first bit of inflation was really shortage driven, right? Remember, during the pandemic, we shut down all the factories. We weren't putting cars and TVs and laptops and stuff on ships from China and getting them onto shelves. At Costco, there was like toilet paper shortages, all that crazy stuff happening, right? So there was a lot of this kind of opportunistic price gouging and just shortage driven price increases that were happening during the pandemic. And as soon as we were allowed to go back to work, a lot of this kind of shortage driven inflation went away pretty quickly, right? We got the toilet paper back on the shelves and things like that started to smooth out. What didn't go away overnight is the labor market shortage, right? You had a lot of people retire early, and no matter how high interest rates go, if you know, bought your house in the late 70s and it went up 500% and you decided you didn't want to work 4 years from your couch remotely and you were going to retire anyway, just sell the house, go move by your grandkids. Again, higher rates don't bring you back into the workforce, and there's this huge labor shortage. It also really drove up the cost of childcare, and California is not one of them yet, but there's, I think, about 9 states in the nation where the monthly daycare cost on average is higher than the average rent. And so if you're working for minimum wage, it really kind of is a coin flip on whether you go to work 40 hours a week grinding to end up net neutral or even slightly negative of where you would have been by just chilling and like watching The Price is Right every day, because the daycare costs eat up all your after tax wages. And that's why, even as the shortage has gone away, right, for goods and things like that, that inflation's still remaining high, because when the labor market is super duper tight, for me to fill my open position, I've got to go out and poach somebody from another employer, and that means paying them more money. And I don't just take that on the chin as an employer, right? I raise my prices and pass that on to consumers. That's why there's no, Senior Taco Bell would be horrified to know there's no 59, 79, 99-cent menu anymore. And that's a function of kind of these labor markets driving up costs. So moral of the story on all this esoteric stuff is that, yes, we've made a lot of progress on inflation and will continue to do so. But this last mile is the hardest to get rid of, right? It's like when you start going to the gym, the first couple pounds of flab like melt right off, but then you grind for months and months and months and the six-pack never materializes. That's like kind of what I'm saying here on the inflation stuff, is you don't want to over celebrate and think those rate cuts are just right around the corner, because a lot of these frictions are still there. For pretty much the first time since they started recording job openings data about 25 years ago, we're in a labor shortage nationwide, right? And so this is why I say that even as things are moving in the right direction, we've still got a long way to go. If you zoom in, right, we've barely ever had a period in history sustained where we had more job openings than we had workers to actually fill those positions with, right? If you zoom that into just the last handful of years, you can see the shortage has improved dramatically, right? We went from about 6.2 million workers short to just 1.4 million-ish in the latest data. but that's still a shortage, right? So moving in the right direction, but just the inflation stuff's going to be inch by inch. You don't want to wait for rates. You want to get in as soon as you can and refi when rates do come down in the future, God willing, but in the meantime, you're paying down principal and building equity, right? And that's the part your brother-in-law always forgets to tell you about. Same thing on the consumer side, right? Consumers are 70% of the economy and about 90% of all the growth that we've experienced since the end of the downturn. It hasn't been from government or business investment or international trade or anything like that. It's been consumers going out and spending money again. That's starting to run out of gas. And you can see that a lot of the spending of late has been sustained by putting it on the credit cards, right? Credit card spending was growing by 17, 18% about a year or two ago. It has since come down to just 5%. So there is a limit to how much we can expect consumers to continue to propel the economy, particularly as charge-offs, which are people just bailing essentially on their credit cards, has tripled. It's gone from 1.5% to about 4.5% at the end of last year. It's still growing, right? It's growing by only 5%, not 18%, but we're still spending above our means, right? So this is both why I think the economy will be slower and we still will get those rate cuts, but we still got a long way to go is kind of the message there. So this is what I want us to make sure that buyers aren't out there doing, right? Celebrating too early and saying, yes, inflation finally dropped below 3%. Maybe my brother-in-law does know what he's talking about and forgets that inflation's going to be sticky such that, we're not going to get these big dramatic declines in rates, and rates later this year aren't going to look that much different than they are now. Meanwhile, the outlook for prices is to continue to go up, right? So if you're waiting to perfectly time the market, you need to jump in the DeLorean, punch it to 88 and go back to last year because prices have already been going up. And meanwhile, rates don't look that much different. You've already left a lot of money on the table by waiting. That being said, again, the reason why us as practitioners need to continue to keep our foot on the gas is just how sensitive the buyers are to even little changes in rates. If you go back to 22, when rates first started going up, it only took about a month for demand to really start to fall off a cliff. Then again, as I showed you in that interest rate chart, we thought, hey, maybe we're there, right? Maybe those rate cuts are right around the corner. That treasury market started to improve. Mortgage rates came down about 30, 40 basis points. And you see how quickly that started to filter through to more buyers pouring back into the market. Rates went back up. Buyer demand retrenched incredibly. And keep in mind, these are just little movements in rates. We're not talking about big jumps in rates. So yes, the worst of the inflation piece is behind us. Yes, we're going to keep moving in the right direction, but that doesn't mean we're going to automatically jump back up to the 400,000 or 500,000 sales a year that we were doing, because even little movements in rates have a big impact when people are trying to time the market and forget that housing is a long-term game. I still haven't ruled out rate cuts, and hopefully I've showed you that we are moving in the right direction. We probably will still get those rate cuts. Even back in April, when a lot of people had kind of written off any kind of rate cut this year from the Fed, I still thought we would get some because of all those kind of underlying fundamentals that I just talked about. And it looks like we're probably on track for that still in the second half of the year. But even there, I think we got to get real about what that actually means for mortgage rates and why it still probably doesn't benefit you to just sit on the sidelines. Mortgage rates are actually pretty easy to figure out, right? There's the kind of risk-free rate of borrowing that we call the Fed funds rate. That's like the free rate that banks can borrow overnight from the Fed, borrow and lend to each other. It doesn't really matter for us, except for it sets the floor on where private sector rates can be. On top of that risk-free rate, we have something called the time value of money, or opportunity cost, which just kind of says that the longer you loan me money for, the more you're going to charge me for that, right? Because you're taking on more risk of what I'm going to do if I die, if I pay you back, and also giving up opportunities on what you could do otherwise with your money. You could buy a stock, you could buy Bitcoin, you could buy gold, et cetera, et cetera. So the longer your money's tied up, the more you're going to make me compensate you for that. On top of that, we have private sector risk, right? It's more risky to loan me money than it is to loan money to the US government. And so there's a private sector premium on top of that. If you put those three pieces together, more or less that explains where 30-year fixed rate mortgages are 90% of the time, right? If you actually apply that to current numbers, we have a Fed funds rate that's about 5.5%. We've got, a yield curve that's actually inverted. That's actually helping us because the treasury market's actually expecting a recession. And we've got about a 200 basis point spread on mortgages above where that 10-year is, right? So that gives us our 6.5 to 7% mortgage rate where we are. Well, if you just apply that basic logic to the kind of long-term Fed extrapolation, and again, we can argue about when the rate cuts are going to happen and all of that stuff, but look at the long term, right? They're talking about a long-term Fed funds rate in the 2.5 to 3% range. That means even after all the inflation is totally stamped out, we're going to have a 2.5 to 3% Fed funds rate. Well, if you add on time value of money and private sector risk to that number that they're telling us they're going to take us to, you're still looking at mortgage rates that are 5.5, 5 to 6%, essentially, even in a steady state, which isn't that much different than they are right now. Meanwhile, California has a 40-year housing shortage, meaning that prices over the long term only ever go one way. And the longer you wait for rates, the more you get left in the dust by prices. And if I'm wrong, again, rates drop to 3% for some unknown reason, another global pandemic or something like that, you can take advantage of that as a homeowner by refining that house. You can never go back in time and start accumulating equity and paying down principal. That being said, again, even with those rate cuts coming, it means we're probably in a best case only going to be at about a 6.3, 6.4% mortgage rate by the end of the year, right? Which isn't that much different. So yes, moving in the right direction. Yes, I think buyer demand will continue to improve through the second half of the year, but it's going to improve to about like 2022 levels, right? Which is better than last year, but it's not a just chill back and kind of enjoy and ride the wave kind of a number again, right? Transaction volumes are going to stay pretty low. The good news is the Bay Area has been punching above its weight, and I think for better and worse, that kind of tale of two economies plays into the hands of regions like the Bay Area, right? Where you have a lot of high income remotable workers who own property already and have stock options and stocks and all of that stuff. And when you look at the statewide number, we've already rebounded from those hyper low levels that we hit back in the winter of last year. But hopefully you can see here just how far we still have to go. And also, if you look at the tail end of this chart, we've kind of plateaued in recent months as that rate, volatility went back up in April and May, really killed off a lot of the momentum that we were building for the spring home buying season in May and in June. If you look at it by price segment across the state, and I'll show you the local stuff here in a second, but if you look at just even the statewide number, you'll start to see why the Bay Area is outperforming, right? Because all of the growth statewide is happening at the upper end of the price spectrum, right? You're talking about 750 and in particular $1 and $2 million homes and up, right? That's been really driving the show and why we've been rebounding. High income earners are still leaning into it and buying, bigger primary and even secondary and vacation homes and all that kind of stuff to Airbnb. What's interesting, if you look at this chart though, is that even the top end is starting to lose some momentum as those rates have gone up. It's still outperforming in June compared to every other price segment, right? 2 million and up was growing by 9% compared to every other segment now shrinking, but it's not the 50% growth that we were having during the first quarter of this year when the top end was really going gangbusters. If you look at Alameda County as a whole, you can see again, we're kind of outperforming. So in June, we were up 5% still, even though the state had kind of plateaued at that 270 or so thousand units. Prices are still rising. We got a $1.4 million median price now, which means 50% of everything that closed in Alameda County last month closed above 1.37 million, which is kind of scary. If you aggregate it up for the year as a whole through the first 6 months, same kind of a story, right? Listings going up, sales going up, prices that are actually up double digits compared to the first 6 months of last year. So again, this is that brother-in-law effect. You could have saved 12.5% if you would have listened to me instead of your brother-in-law last year, and there's nothing to indicate that prices are about to tank. And by the way, 12.5% of $1.35 million is that's actually real money. So if you look at the sales trend, it looks very similar to the statewide number, but unlike California, we're pretty consistently outperforming 23 levels. We're just not punching way through to even 2020 levels yet. So yes, moving in the right direction, but you can just see how macro driven the environment is, that even places more expensive like Alameda County look very similar to the statewide average that includes places like the Central Valley, right? If you drill in to the local market by price segment, you can see the same thing, but just even more exaggerated, right? And I had to rejigger the kind of price buckets here because there's not a lot of stuff under 800,000 anymore in Alameda County with a median price of 1.35 million or whatever it was. But you can see the same exact trend playing out locally that I showed you statewide, right? That the light green, red, and orange stuff, which is like the expensive stuff, is growing way, way more than the entry level. We just don't have much of an entry level hit in the MLS still, even with active listings starting to grow. So you still have this kind of tale of two economies playing itself out locally. Most of our markets happening at the upper end, and we still have just such a density of high income earners that's kind of lending itself again to this over performance. But trend wise, all of the macro stuff is still very relevant. If you drill down like locally, you can kind of see like a difference between like Oakland and Berkeley, right? Where like in June, the Oakland stuff, in particular, sales were down, but also median prices kind of moderated. You can see the price is actually still up year to year. There's just a fairly low base of transactions happening, but Oakland tends to have more entry level stuff, right? And it's down in sales, whereas the median price in Berkeley is a lot higher, right? And you still see kind of the transaction numbers going up even in June, and especially when you kind of aggregate it up on a year-to-year basis through the first 6 months, right? So this kind of entry level underperforming, top end overperforming seems to be borne out both, locally, both when you break it down by price segment within the county, but also kind of if you pick out like individual markets. This is also a shameless plug for our local market data. We publish all these for like every city pretty much in Alameda County that you can go and download and take a look at. We have all the other counties as well. The cool thing is that we're finally starting to see more supply come online, but the story there is really similar to the interest rate story, right? Like, yes, rates are going to come down, but it's going to be very slow going. And same thing on the inventory front. Yes, supply is a bright spot and it's going in the right direction now, finally. But you don't want to wait around for prices to tank because, inventory is going to stay tight for the foreseeable future, even as you're starting to see more units hit the MLS. So let's try and break that down a little bit, right? Because for the last 2 years, I've been coming to you talking about the interest rate lock-in effect, right? Where you have a lot of homeowners that are out there under 4% mortgages that are very loath to give those up, right? Unless you got a metaphorical gun to your head, you're going to stay in that home because you've got the lowest interest rate of all time. But even as that remains true, the percentage of people below 4% has shrunk gradually as you've had new homeowners come into the market, as people have had job changes and whatever and have had to move. We've gone from essentially 3 out of 4 being below 4% to just 2/3, and that's still a lot, right? But it is inching in the right direction. The amount of people with 5% rates or higher, and those are people that we're not really asking to eat that much, right? Like going from 5.5 to 6.5, that's not that big of a deal. It's the jump from 3 to 6.5 that's really painful, right? That's grown from about 10% to now about 17%. So we are starting to see that lock-in effect erode, even though you still got a lot of people out there locked in. And again, you can see that, right? If you look at Alameda County, we're putting more homes onto the MLS. This isn't total actives. This is just how many are we putting onto the MLS new every month. Those numbers are moving in the right direction, and we put more on in April and May than we did anytime during all of 2023. Still not really in great shape from an inventory standpoint. Nothing to suggest that prices are going to start coming down, but at least we're seeing more homes actually show up on the MLS. The July number, you see it there, 812. That's only like the first 3 weeks so far of July. So it looks like that has started to resume. So why would people be moving, even though, again, 2/3 of homeowners have less than a 4% interest rate? It's because the financial aspect is only one piece of your housing decision, right? Like having a low rate is great, but you also need your house to work for you. And these are numbers just since the pandemic, right? 2020 through the end of last year. You're talking about, almost 1.8 million babies have been born in California. You've had about 1.2 million people die, COVID and otherwise, right? You've had a bunch of people that retired early and left and went to Idaho or North Carolina or wherever folks go, and all of that stuff. So again, having a 3% interest rate is great. The one thing I'm not showing you on this chart, which is kind of near and dear to my heart, is like the divorces, right? We're doing about 1 million divorces a year as well. And so even though, we've got a lot of people locked into super low rates, you've got a lot of these life events that have happened. And, I kind of joked the other day, maybe inappropriately, I kind of got some flack in the chat in a private message, but I said, it doesn't matter how low your interest rate is. If your wife starts dating the bartender down the street, you still dump the property. So like, just to kind of underscore why, you'll still see that kind of inventory go up, even with so many people locked in to these hyper low interest rates. But you don't want to try and over celebrate and ride the wave, because even with this double-digit increase in the number of homes coming on to the MLS every month, you can see in Alameda County, we're only barely back to where we were during that first couple of weeks of the shutdown in March of 2020, right? So again, you don't want to over celebrate. It also kind of flies in the face of your brother-in-law's forecast. It says, oh my gosh, there's going to be so much inventory. You're going to save a couple of $100,000 and get it at 3% interest rates later this year. I just don't see it in the data. And when we look at the potential for foreclosures, I don't think you're going to see it there either. Meanwhile, affordability continues to get worse, right? California just had its 12th month consecutive of home price appreciation, right? So if you're trying to perfectly time the bottom, again, you need to get in the time machine and go back to last year, because prices have been rising and the pace of growth has actually been increasing as well. You can see the same thing again when people weren't listening to me at the beginning of 23, when interest rates had initially gone down. You've already seen, again, the median price in Alameda County has gone from about $1 million to 1.3 million and change. That could have been money in your pocket. Instead, it's principal balance outstanding on your mortgage for whenever you do decide to jump into the market. And again, jump in your time machines, right? Because when prices were actually going down in Alameda County, it was at the beginning of 2023. Since about the summer onward, prices have been rising, and we've had many months with double-digit price increases locally, right? So it's getting worse for you as a buyer, not better. You forget that, guess what? Every other buyer is waiting for is lower rates too, right? So whatever you gain, even if I am wrong and rates go down a 10, these numbers are probably going to get even worse as price growth, starts to just ramp up in the face of increased purchasing power. Again, if you have buyers that are highly qualified and employed and all of that stuff sitting on the sidelines, I'd be showing them this, right? If you go back to the end of 22, took almost 3 weeks, maybe a little bit more than that, for a home to hit the MLS and go pending. Recently, it's been less than 2 weeks. Homes are going quicker, not slower, right? And so, again, it's not just that prices are going up. It's not just that rates aren't poised to drop. the market is just getting more and more competitive because, outside of these kind of one-off market shifts where people get freaked out by the news, as soon as that stuff gets digested, we go right back to our traditional forces, which is too many buyers, not enough homes to put them in, hyper competitive marketplace. And that remains true even at 6.75%. In fact, you can see that in over list price stuff, right? It's not just that homes are selling quickly. It's not just that prices in Alameda County have been growing since the summer of 2023, most often by double digits. It's also, you could go back to the beginning of 23 when the market was really soft, and you're talking about 2/3 were selling at or below list price, right? They were closing at or below list price in Alameda County. Fast forward to today, you're talking about 3 out of 4 homes are closing at or above list price, right? So barely anything's being reduced. Everything is selling quick, and that median price continues to fall out of your reach. So this is kind of stuff that suggests that, your brother-in-law is not as good at math as me, and why it might not behoove you to sit around on the sidelines, because the numbers on the ground tell a much different story than what those newspaper headlines would have you believe. What about prices that continue to go up? Has it gotten super unsustainable? I am worried that prices are back to kind of being out of reach. If you look at Alameda County, you can kind of take the typical median household income of about 140,000 and change, and actually look at current interest rates and figure out what should home prices look like with people that make $142,000 a year facing a 7% interest rate. What is an affordable home price in Alameda County? If you crunch those numbers at 7%, the affordable home price for somebody making 140 grand a year is about $650,000. Well, we can compare that to where, the actual home prices of 1.3 million and change. And people go, man, maybe my brother-in-law is onto something here, right? Sales prices are, almost 10 times what the median income is in the region. What would it look like if prices did? And again, this kind of throws my forecast out the window and just asks, what would it look like in a kind of revert to norm, kind of if we had a worst case bottom falls out of the market, revert back to that affordable median price kind of level? Well, I'll point out that prices in Alameda County are never at the affordable price. They're the kind of nice place to live premium, where we're always about 30 to 40% higher than what the affordable number is. And that's both the kind of nice place to live premium as well as that structural housing shortage that's just always present, right? So we would never fall back to the affordable price, but we could fall back to that kind of historic premium, which would equate to about a 30% price decline. So then why am I not, saying that's going to result in 2008 all over again? It's because the differentiating feature this time is how much people have in home equity compared to last time. We didn't have a lot of 0 down 5/1 option arms. These were 720 FICO, high down type of mortgages. And in fact, if you look at where people are right now, 95% roughly of Californians with a mortgage have at least 20% home equity. Almost 90% have at least 30% home equity, right? Which is a much, much different scenario than where we were in 2008, meaning that even if again, I'm terrible at forecasting and the bottom does fall out of the market and prices drop by 30%, that still leaves 88.6% of Californians who aren't upside down on that home, and you don't foreclose on a house that isn't upside down as long as you're current on your payments. In fact, you're talking about almost 80% of people have 40% equity that could potentially withstand a worst case scenario bottom falling out of the housing market kind of a number, which again, isn't what anybody's forecasting. Even the most pessimistic person isn't forecasting that. And the kind of final nail in the coffin for your brother-in-law's forecast is not just that prices are going up, not down, not just that I have a really low payment on my current house because I've locked in the lowest mortgage rate of all time, not just that 95% of people have at least 20% home equity, but 98% of people are still paying their mortgages on time, right? We are really prioritizing those mortgages even if we're falling on tough economic times, right? I'll let a lot of other stuff go before I let that 3% mortgage go, because the rental market is no picnic either, right? And also just finding a rental is terrible. So I just don't think we're going to have the kind of inventory needed, either normal inventory or distressed, to facilitate the kind of price declines that would make it make sense for these buyers to sit around on the sidelines. People have already gotten left in the dust, right? I showed you how a couple of years ago, median price in Alameda was $1 million. Now it's 1.3, right? We can extrapolate that forward into the future pretty easily, right? And like, hey, those are the junior analysts. They are agreeing with me. But it's kind of scary, but also I can say pretty confidently that we're going to look back in 20 years and long for the good old days of $1.3 million prices, right? Because we're not going to start dogs. We're not going to start building an adequate supply of housing, and we still have one of the strongest economies on earth, meaning that over the long run, prices only ever go one way. And that's why buyers need to remember, like, the number one best time to buy a house in California was a long time ago. But the second best time to buy a house in California is as soon as you can. The reality is you're already paying somebody's mortgage. It just happens to be your landlord's right now, not your own, right? And if you look at the numbers, right, the typical household in America has about $192,000 worth of net worth. But if you take everybody and separate them into two separate buckets and put all the homeowners into one bucket and all of the renters into another bucket, you can see pretty clearly why you want to get your foot on the property ladder as soon as humanly possible. Yes, there's ups and downs associated with the macro environment, but it's always been true that homeowners are the only ones that get ahead in life at all, right? If you take renters and look at them in 2022, which is a 3-year survey the Fed does, they were no better off than they were 30, 40 years ago. Even if we can come up with hypothetical thought experiments that show me, just stay a renter, take that maybe differential that I might be paying on a mortgage and invest it in the stock market and end up better off. Those are just like thought experiments that we do on the back of a napkin, and we can all do multiplication and stuff like that. But the reality is that never actually materializes in real life, and renters don't go out and make a bunch of whiz-bang financial moves. They spend more and drive a nicer car and rent a fancier apartment and take their friends and family on nicer trips. And it's only through home ownership that people actually end up getting ahead. Just side note, I'm the son of a guy who didn't even graduate from high school. The reason why I do speeches like this every day isn't because he had a bunch of fancy, econ PhD buddies to plug me into at UCSB. It was like he owned his own home, and I could just focus on being good at math and spreadsheets and stuff like that. That's what home ownership is all about. That's why you want to get in as soon as you can. It's not about timing the market. Prices over the long run only ever go one way. That's why you want to get in as soon as you can. And if I'm wrong about rates, that only benefits you in the future, because you can't go back in time and build, equity on a house you didn't even own. So get people focused back on the price. I would honestly print this out and show it to every gainfully employed high income renter I know, and just say, look, you want to be blue or you want to be yellow? It's pretty much as simple as that. And that's why I do what I do. And if you do that and really lean into, knowing the transaction and being able to communicate why you're the bomb, that I honestly am not worried about the macro stuff. Rates will come down, sales will go up. I'm not worried about these practice changes, because they still need us to buy and sell homes. I think that, as long as you really bring your A game and lean into being that trusted advisor and market expert and communicate, why we do this, which is shown so clearly here on this chart, that I honestly believe sky's the limit. So with that, I know I went on and on and on, but I would just say thank you so much to Divina, and just kind of remind you got the numerical forecast, which I already beat up, but it's a double-digit increase in sales, prices that continue to go up, but rates that aren't going to come down very rapidly. So again, don't wait for rates. Step up your game and knock it out of the park. Thanks so much. Oh, and I see I did miss a question here. Do I suspect that the combination of layoffs, increased property taxes, inflated insurance, I think those will continue to be strains. Well, we have Prop 13, right? So they're not going to be, the property tax increases aren't going to be too egregious because of those Prop 13 protections, even in this high inflation kind of environment. The insurance stuff is problematic. I didn't know how much to personally share, but my insurance saga is nuts. It went from like $900 a year when I moved into my house to $3,000 a year a handful of years ago to like 11,000 a few years ago. And then I got dropped a year ago. Even at 11,000, they wouldn't renew my policy. That's going to definitely tack on costs and disrupt transactions and jack up the cost of keeping these homes going and stuff like that. But I think that still doesn't necessarily to me translate to foreclosures, right? If you have all these long-term homeowners with tons and tons of equity and their insurance premium goes up from 1,000 to 11,000 even, you don't let that home go necessarily because of that, especially in a market like this. You might go, whoa, dude, I'm not paying $11,000 a year for homeowners insurance, but that doesn't translate to throwing the keys back to the bank. I think plenty of demand out there, throw it on the market and dump it, right? And somebody's going to be willing to pay $11,000 a year. So not translating into foreclosures, definitely a strain, right? And we have commoditized the housing market and stuff like that. But again, I just don't think it means a bunch of foreclosures necessarily because there's just a ferocious appetite for that inventory. And these homeowners probably have a bunch of equity. Like unless you bought yesterday, you already are in the black on these homes, right? So like it's hard to see being current on the current payment under your old policy and having a bunch of equity. I mean, you're going to want to sell that. You might short sell it, but even there. Great question, though. I love it. Anybody else, or did I beat you all into submission? I know that was a lot. That's why I like to provide the slides too, so that you can kind of digest later and just find that one kind of nugget that resonated or that speaks to your current client who's like, oh, this person's got to see this one, right? Or whatever. So hopefully that helps.
I think you gave them a lot of information there, Jordan. And again, keep in mind, these slides will be available for everybody. And all I heard was that the market's going to turn for better. That's what I keep hearing. I hear
It's actually already happening. Yeah.
Yeah. No questions for Jordan. Come on. We won't have him again until next season. I think we get you about twice a year, right?
What's that?
We get you about twice a year. Don't we usually get you here twice a year?
Twice a year, and you can come see me in Long Beach too if you're a real glutton for punishment. That always works too.
All right, so I'm seeing some quick questions pop up. Thank you as always. The slides are great. Please repeat your statement about the last mile.
Yeah, I think the last mile is going to be the longest, right? So the idea was just that things are going to keep getting better, but I just wanted to keep, kind of prevent you from being overconfident such that you take your foot off the gas because, on the one hand, and this is the stuff you're going to read in the newspaper, right, is that inflation's coming down. We're below 3%. We probably will get a Fed rate cut, right? And all of these kind of good things that might suggest like, ooh, maybe I should wait around, and forgetting that like that last mile is the hardest because there's a lot of structural headwinds that make, again, that drop from 9% inflation to 4% happen faster than the drop from 4% to 3%. And there's just like a lot of reasons why. Again, that's the kind of heading to the gym analogy, right? Like the first couple of pounds melt off, but then you never get the six pack just because of the labor shortage, how much people are still spending money. The economy's still growing. It's just not growing as fast. So it's kind of the but forecast, right? Like, yeah, things are continuing to get better. They're going to keep getting better, but don't take your foot off the gas because it's going to be, very slow and kind of inch by inch.
That's awesome. And yeah, I apologize. I was on a call. Did you talk much about how the elections are how you feel the elections will affect it?
Yeah, luckily I didn't talk about that. But the impact of elections historically has not been, we haven't been able to find an effect statistically, right? So like you can eyeball something and make a chart and say, here's, election years and this thing happened, right? Like prices went up in 6 out of the last 12 elections and stuff like that. But if you try and do it scientifically and put it into a statistical model, once you put in, and you can do it, you can slice and dice it however you want by party. You can look at newbie versus incumbent. You can look at, however we've done it 6 ways from Sunday. But once you put in the economic data, what was going on with rates, what was going on with jobs, what was going on with people's incomes, how many people were having babies and all that, the election just wouldn't show up no matter how you put it in. And so I think those are longer term structural, like what happens to Fannie and Freddie, what happens to tax policy, and do we let people deduct mortgage interest, like some of those big structural things that will play out over the long term. But I think in terms of how many people are going to buy and sell homes this year, I don't think, they might wait for a couple of weeks for the dust to settle, but it doesn't have a big impact. It's more about what's going on with my job. Have I been kicked out of the house? Blah, blah, blah.
Yeah. All right. Any other questions that anybody wants to address? Let's see. There we go. Here comes another one in there, Jordan, if you want to take a look at that.
Oh, absolutely. The lack. Yeah, I think I need to take Janisha out to coffee or something because it seems like we could nerd out forever on this. I totally agree. All of those things diminish affordability, right? Like not wanting to give up my property tax base is a huge kind of concern. You have to still, we got 19 through, so you can take your property taxes with you now wherever you go, as long as you're over 55. But you still got a lot of people who aren't 55 that have bought and are still benefiting from Prop 13, and that makes our underbuilding situation even worse. Definitely. I think the insurance premium issue means that it even more so means that housing goes only to the more affluent, right? That's the reason why housing is as unaffordable as it is already, is because this housing shortage means, the high income people still got to live somewhere. So yeah, it might be a 1938 1,200 square foot bungalow, but I want to be close to where I work and I make a boatload of money and I will pay $1.4 million for that house. And it makes it even more so that those types of folks are going to be the ones who can get the houses, right? Because of insurance, and who can stomach that cost and all of that. So absolutely, these are all reasons why we need to get serious about housing supply, about building every single kind of housing, from the most popular like ADU all the way to the least popular like apartments. Because and it's unpopular to say, everyone likes to build workforce housing and likes to build affordable housing. The reality is, though, like the stuff that's intended to be affordable just gets priced up by the housing shortage, because again, those high income people got to live somewhere. So we got to build even expensive homes, right? It's not popular to say we got to build a bunch of $5 million homes so we don't have these executives purchasing up all the 1,200 square foot bungalows that are 50 years old, right? It's a housing as a whole chain, right? It's a ladder. And so you can't just build a bunch of, because it gets cannibalized by the marketplace. So, but yes, absolutely 100% agree. Got to build more housing, got to find ways to enable people to sell or move out of the housing that we already have if they want to, right? And a lot of people want to, but can't for various tax and other reasons, and just lack of a where are you going to go, right? But definitely that is the thing and these are all symptoms of just how critically important it is for us to get our act together on housing supply. So thank you for that question. I absolutely love talking about that.
All right. And so she gets a coffee. So now we've got a few people.
I'll buy you that coffee myself. Yeah.
That's fantastic. All right. Any other questions? We've got time if you want to keep throwing those in there. I love this. All right, Jordan, this is such great information.
Let me shamelessly throw one out just on the policy front that I think might, be exciting for folks in your area in particular, and also to motivate you to get active when Divina puts out a red alert or whatever else happens on the policy front. Because good policy, not just for housing supply in terms of new building and all that stuff, but also for turnover, it can really make a difference. Right now, I went through and crunched the numbers. There's a bill. I don't know if Jimmy Panetta goes all the way up to Alameda County or not. He's our congressman, but there's a bill that would double the capital gains threshold that they're considering in Congress right now, and it would have a dramatic impact on one of those reasons why people don't move. You got long-term homeowners facing capital gains, and I think I crunched the numbers statewide, and I can provide these to Divina for Alameda County in particular, but the number of folks that are currently locked in by capital gains is like 2.7 million of the like 6 or 7 million homes that are out there, owner occupied homes in California. If we double the capital gains threshold and we can support this bill and get, whoever needs the support that they need to make it happen, that number drops to like 1 million. So we would get 1.6 million homes that, not all of those folks are going to go out and move right off the bat, but at least they won't be locked in by capital gains. So like, even if 10% of them move, 10% of 1.6 million people that are no longer locked in, that's 150, 200,000 transactions, which is like almost a whole year's worth of sales at last year's level. So
that would be amazing.
Yeah.
Send me that information and we'll share that.
And you guys are suffering from that even more just because the median price in Alameda and, Berkeley and everywhere has gone up so much faster than other parts of the state. So
yeah, that's great. Anybody else have questions or anything more?
100%, David. Yeah. But they're talking about doing it permanent and doubling it to 1 million and indexing it to inflation so we don't find ourselves in this situation anymore, which would just be a huge win for homeowners. I don't know why we want to tax homeowners for building wealth anyway, but that's, All
right. Well, I think you got them all.
Awesome. Well, I really appreciate the invite and the opportunity and for everybody's time and attention today.
It's been amazing. You always give us such great information, and we've got the recording and we have the slides. So for those who weren't able to make it, or for those that are here that need to hear it again, we'll have this information available. Jordan, it is always a pleasure. We have your colleague, Gov Hutchinson, coming in a few months. So again, thank you everybody for being here for the July Power Hour. Be on the lookout for information, broker meetings coming up, a lot of meetings coming up, and be aware of all the changes happening with the MLS. Thank you again, everybody. Jordan, appreciate you. Have a beautiful day, everybody. Thank you for the accolades. We appreciate your membership and appreciate your support of Bridge Association. Have a great day, everybody. Thank you. Thank you, everybody. Jordan, thank you so much for being here. Bye, everybody.